Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking New Zealand's greatest export, Xero Limited, ASX code XRO. G'day, Elio. Tell us about the company.
Yeah, g'day, Phil. Look, although Peter Jackson might argue with that with the Lord of the Rings franchise. But anyway, you're right, though. I thought we'd cover a company that I know has commanded a lot of eyeballs. They've reported recently, and that is Xero. And as you say, they're a stellar company that comes out of New Zealand, but obviously they made their name here in Australia. But they're also a global story because they're expanding into the US and UK. And for those that are unaware in regards to Xero, it is an online accounting system and service, for example. So it doesn't just record your basic ledgers, but it effectively looks after everything from admin to payroll and the like. If you're running a business these days, you're basically going there, as opposed to back when I started this caper, many moons ago when dinosaurs walked the earth. Back then, we all got myobs and reckons, and now that's all changing, particularly here in Australia. So look, there's a lot to unpack in regards to Xero, but suffice to say its share price is heading in a northeasterly direction, which has got a lot of people excited. And I think now's a great time to discuss it because it has been one hell of a ride.
And having just moved house and getting into a new house with lots of repairs to be done, I've noticed that so many tradies now, they send you the quote via Xero, you accept the quote, and it all seems to be a seamless accounting operation in the background, doesn't it?
Well, that's the idea. Ultimately, if you don't make it easier for the user, for the person who pays your wage, as it were, then why bother? And effectively, a tradie who does use the Xero services, and let's face it, if you've been working in a corporate environment for the last 20 to 30 years, then you're pretty au fait with regards to computer systems nowadays, then you are going to be doing that. You're going to be sending these invoices, and it makes it nice and easy for the customer to just click and approve, and away you go. So very much it's evolved a hell of a lot from where it started. But I think that sticky nature in regards to, because of course, if the tradie decides to move and go to another competing product, that's fine. But then they have to convert their entire systems and their entire ledger programs and like all over.
And also learn. and
learn the education. Yes, that's right. And that can take a bit of work and effort. And in this modern age, that's something that scares a lot of people, in particular tradies, dare I say it. But nonetheless, it's got a sticky client base. They've got that hockey stick approach, and they're really creating that network effect. That's the holy grail, as it were, that we all try to achieve, that network effect where you become so big and you're in so many companies and embedded in there and you can't be moved, that really that's what you want to create. And that's why you take the hit early on in order to create the growth later on. And with still scope to grow, particularly in the US as well as the UK, that's why Xero's up for discussion today.
So the results came out recently and the market obviously liked it, although I'm always amused when analysts revise their price targets after the fact. So tell us about those results. Yeah.
Look, it's really interesting because obviously I don't think I'm shocking anyone when I say that the results are really good and they grew quite well in their local markets. They're profitable, they're generating cash flow, the whole range of pluses and pluses and pluses. But when you see the analysts, as it were, upgrading their price targets for the stock, it's almost as if it's a concession game. And look, to be fair, Xero hasn't traded above its target price since, I think it's back in April or March, yet its share price has gone through the roof in that time. So it just shows you how analysts in their infinite knowledge will re-rate a business on the back of some updated numbers, not necessarily because they feel that the business is justified being at that valuation, but because they don't want to look silly amongst their peers, because we all get to see who it is that does rate a particular business. And as you said, the share price recently did see a jump, and what we got were pretty much upgrades across the board. There are a few brokers who, still stick true to the idea that the stock's pretty fairly valued at the moment. but we did definitely get a significant amount of buys and upgrades in this recent time. And effectively, everyone upgraded their price target, and it felt like I think it's just a smidgen in terms of consensus, a smidgen under $200 right now. But really, that's just to prepare Xero for its next phase of growth, irrespective of the fact that people felt that the Australian business was a little mature and therefore maybe that impacted its ARPU, which is average revenue per user, in case we love our acronyms in the finance space. So that saw that come down, and that might have possibly led to that, I suppose, revision in regards to EPS, which came down a little. But in terms of price target, it just keeps going up because analysts just don't want to look stupid. It's a harsh reality, particularly in stocks like Xero. And no doubt, I think if investors look hard enough, they're going to find plenty examples of businesses just like this.
So their EBITDA increased by 51%, I believe. That's pretty impressive in the numbers game.
Yeah, very. I mean, we need to remember that in terms of profitability, they're coming off a very low base. So, I mean, if I can go to Stockopedia just for a moment, the value rank is putrid, as you'd expect for a stock that's gone up as much as it has. And it's hard to, I suppose, if you're a die-hard on the wall value investor, to suggest that stock like Xero is a screaming buy at the moment. So achieving that EBITDA growth was a real line in the sand, as it were. But I just hasten to caution everyone to remember that with Xero, it has had a checkered history, as it were, in regards to its profitability being up or down. It spends a lot on marketing. It is by definition the purest of growth type businesses, where it reinvests a lot of its profit that it does make into its business in order to try to continue to expand it. And let's face it, the way you treat something here in Australia is very different how you treat it on an accounting sense in the UK and especially in the US, and even there where they've got, some may say, archaic systems. So there is a constant need to continually reinvest in this business. And yes, they're now starting to come out, as it were, of that phase where they were just plowing a lot of money or profit into the business, and they're now starting to grow. And we're starting to see that in things like EBITDA, especially when you look at that sales trajectory. I mean, the revenue that they've been generating and continues to generate over the long term just can't be sneezed at. I mean, it's risen by 25% CAGR, which is constant annual growth rate, an average of 25% every year. And that, again, is nothing to be sneezed at and has flowed through to all the metrics. That's why you keep seeing that price target go up and up and up.
So with a software as a service company like this, are the metrics simpler than for other companies? Because it's basically just their software system they're offering, subscribers, and the cost of marketing. Are they the main metrics that an analyst would look at?
Yeah, to a degree. They'd also look at capital expenditure, so what the company actually invests in regards to continuing to improve its platform. Because let's face it, in an IT environment, you're never there. You never get to that point and then stay there. If you get to the top of the tree, as it were, you can only go down, and that's not where you want to be from an IT perspective. So if you want to continue to grow, if you want to continue to expand, you need to constantly reinvent yourself, either adapt for new improvements in regards to technology or develop new technologies, which, let's face it, you got to build first, and that costs more. Once you do that, though, then you get the benefit on the other side, like that invoice situation that you were describing earlier. So, look, generally, yes, it'd be relatively easy because we look at that ARPU, that average revenue per user, and we can figure out whether their number of users has gone up or down. And we can basically extrapolate that out, plus the marketing expenses, plus the capital expenditure expenses, and hence we come to a target value. Now, that's just on what we're talking about now. But then you have to consider the network effect. You see, the more clients you retain, which are effectively the easiest clients to win, creates that, the more of them you retain, creates a hockey stick effect, right? Whereby you come off that more solid base year in, year out. So as you continue to grow your company, you also maintain that solid base, and that becomes locked in. Effectively, that base becomes bigger. That growth as a percentage still might remain relatively the same, but because your base is so much larger, it actually compounds that increase. And as the great Albert Einstein once said, compound interest is the eighth wonder of the world. Those that understand it earn it, and those that don't pay it. And when it comes to a situation like Xero or any of those other big US mega tech businesses, let's face it again, investors backed them a hell of a lot earlier than when they became profitable because of this idea that they could control the entire network. Well, then that's what you're getting in regards to Xero. And hence why, even if you're a junior analyst, you might come up with a big smirk on your face thinking that it's possibly a sell, and then you'll get the senior guy sit there, just cross that out and change that with a buy roll and put that down as a buy, because it'll take a brave person to stand against a juggernaut, which has been Xero in recent times. But I think there's reasons for us to be a little bit more cautious than, say, what we were beforehand.
It's interesting that the momentum score in Stockopedia is 70, which is not that high, but you recently wrote an article pointing out the technicals of the share price growth over the last couple of months, and they seem to be a little bit at odds with each other, those two different views.
Look, they are. I mean, because when we talk about it from a charting perspective or we are looking at it at absolute terms. So the price started here, went to there, it's done this, etc. Therefore, that's an absolute return. Whereas the ranking perspective actually comes from a relative side of things. And let's face it, we've been in one hell of a bull market. So it's not been hard to find, Phil, stocks that have gone in a general northeasterly direction in recent times, as Xero has as well. So I think it's fair to suggest that, yes, it's done well on absolute terms. And yes, we all wish we may have held it back when it was dirt cheap through where it got to right now. But I think on a relative sense, when we look at the company on a relative basis, it's not been necessarily the highest ranking stock that's out there from a momentum perspective, even though in absolute terms, we see the fact that it's approaching $180 odd or getting up to 200 inevitably. And therefore, we all get pretty excited by those big numbers. But in reality, on percentage terms, there are companies that have done actually better than it, and therefore they rate or rank higher, because unlike it being absolute, that binary 0 to 100 means that everyone's assessed on a relative basis, to which Xero is definitely being good. Don't worry, I'm not going to sit there and poo-hoo it. And if you talk about it from a chart perspective, that recent pop we've seen also has been a great saving grace for it, or doing quite well. But I think on a relative basis, it does bring it back to the pack a little bit, and just adds a helmet of rationality for those that may feel that they missed the boat in regards to what Xero has done in recent times. Well, you know what? There's actually stocks that have done better than that in our view in terms of price momentum. And therefore, if you're on those guys instead of this one, you should be even happier.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So it's one of those situations where a rising tide is lifting all boats, isn't it? Yes. Just to mix another or into that.
Yeah, no, there's a
helmet of, you called it the helmet of rationality, I think you said.
Correct, that's right, yes.
I'm going to steal that. That's a great line. The Australian stock market doesn't have a very large tech sector. So is that a factor at play here? Is that the only way to get exposure to tech stocks, this one and only a relatively small number of other stocks?
That is an excellent point, because quite frankly, Xero, I think, is the second largest constituent in the IT sector, the largest being WiseTech, of course. But when we're talking the IT sector here in Australia, it is just a fraction of, say, the US, where the Magnificent Seven have commanded so much of the movement, and a large percentage of them are actually tech stocks that command so much of that market cap, into the trillions even. So when we look at ours, when I saw that ETF that was launched, the technology-focused ETF, or index, I should say, that couldn't help but chuckle, because we all know that the internet's going to be more of a part of our daily lives over the next 10 years. I'm yet to encounter anyone that's disagreed with me, and I've been using that line for the last 20 years, so that pretty much shows you that I've been right up until now, and I dare suggest I'm probably going to be right in a few years to come. Considering that, the IT sector here in Australia is actually quite small relative to many global partners, and obviously the US is most visible in regards to that. So you're right. If you want a bite of IT and you want it to be Australian domiciled, then Xero is one of the very few options that you have open available to you. The fact of the matter is, though, is that they haven't become the size they have just being focused here, or being focused in New Zealand even. But then, of course, they expanded over here. They did initially have dual listings at a time, but they've removed that New Zealand listing because, quite frankly, that's a much smaller market. And they have their exposure in wanting to grow into the UK and the US as well. And the US is a much larger piece of the pie when it comes to, market share and all that sort of thing. So the sky's the limit there in regards to that. And they're actively trying to expand there in particular, given that here in Australia, they tend to be a bit more mature and the growth engines are really coming from overseas. So, yep, long story short, Phil, if you want to invest in IT, chances are you're going to be all over what Xero does and how it goes about it. But quite frankly, they've become the business they have, not because of their focus here, but because their focus overseas. And that is a key driver for earnings moving forward.
So talk to us about that growth. And they are moving into other territories. Is it with acquisitions or just building the brand in other territories?
No, it is mainly building the brand in other territories. So with IT, effectively, it's less about that intangible brand element, as it were, unlike a media company, for example, or the like. Whereas here, you can build that trust through that service. So they are growing organically and they are growing into places like the US. And many of the broker upgrades that you see that little price target has done has been on the back of that US growth story. And again, it's a tried and true formula. Once you get in, you stay in. So they're obviously spending a lot of money and a lot of expenditure in regards to getting US businesses on board until eventually when you open up a brand new business out of the US, most likely out of Delaware or wherever the case may be, so that you're paying the smallest amount of tax, then that is where you're going to consider a Xero. And the fact that they have so much already pre-prepared within their operations does also add as a big boon. So if you're starting out a company, knowing that you're with a partner that has so many options available to you to allow you to expand your business and do so successfully, that's where you want to definitely latch onto one of those. And let's face it, if you were to ask any business operator here in Australia that does use Xero, whether they could live without it or not, I dare suggest the negative is probably going to be their first response. So they'll want to build that in the US. And being IT and buying it online, you don't need those boxes in the stores anymore or any of that sort of stuff like we might have been used to. Nowadays, all you need is one of those shiny little cards, a few seconds to jump online, tap away, and bang, there you go. Then there's a little bit of an education process. And then you hand it over to your accountant once you become popular. Because, of course, accountants can access all that information as well. Another one of the major benefits of Xero and what it does. And a growing list of accountants have also become enamored with the software as well.
Mm. So how is that outlook looking for the growth? I mean, it must be quite a large operation to try and move into a market like the US or the UK as compared to New Zealand and Australia. And surely there's going to be a lot of competition there as well.
Yeah, look, I think that's a really good point because when you look at their numbers, irrespective of the fact that they do look outstanding on the surface, I mean, when we look at things like sales growth, it sits around that 24%, which is, bloody good. But still, obviously, we know that there's companies out there that can do a little bit better in regards to that than what that company's been able to do. And I think if we look at return on capital, I think we're sitting around 16%, which again is still better than you'll get in the open market. It has an operating margin of around 17%, which again is really good, but for an IT business could be higher as well. So obviously they're ploughing a lot of investment in regards to it. I think if I can look at other companies, and often what I see when they try to expand to new jurisdictions like the US or UK, etc., their different legal treatments of various different transactions and the like can prove a bit of a hindrance. You don't want to get it wrong because if you get it wrong, then that's going to really hurt you. And let's face it, in Xero's business, it is all about trust. I mean, it's the trust that that system actually works and does everything correctly, links to all the appropriate authorities and does all that sort of thing without a glitch, that really is a cornerstone of its success. So yes, it's very expensive. I don't think it's going to be too hard to convince those with exceptionally deep pockets that they need to keep investing in a business like this. Even though they're self-funded at the moment and generative as they are, they may look to acquire a US company over there in order to expand a certain feature that they may not have or they're looking to build on, etc. It may actually just be cheaper to go, like I say, to go and buy that competitor than build it themselves. So I'm not going to necessarily say never when it comes to their US expansion plans. But when I look at other companies, they've come a cropper because of those different jurisdictions and the different tax treatments. So this is a company right at the coalface. They've got to get this right. And when you look at all the analyst coverage recently and all of those buys that come across the board and the like, Ben Graham couldn't justify the valuation on this in a pink fit. So how do these guys necessarily do it? And it is all about that US growth expansion. So notwithstanding the continued investment, the fact that they do need to spend a hell of a lot of money to grow into a new jurisdiction, to grow that business and do what it has to do in order to align itself to the various taxes and the like, people believe this story because of that network effect. The fact that once you're in and you stay in, you never go anywhere. And this is a very different business now than when it was when it started way back when. They've been successfully executing that strategy here in Australia. They want to successfully execute that strategy in the UK and US, and assuming they get the jurisdiction thing right and the tax treatments and all that sort of thing, there's no reason to suggest they can't replicate that particular model overseas. Notwithstanding how good the numbers were recently, though, they were, if you've probably gathered from my general candor, a bit ho-hum in the sense that I wasn't necessarily thinking they were shooting the lights out on the back of these numbers, but I'm not brave enough to suggest an end to their trajectory because I think that a company like Xero could potentially be in the hands of many small businesses come this time in a decade.
Yeah, shout out to all the tradies that seem to be using it and helping it to drive the growth.
Yeah, very much so.
Yeah, Elio D'Amato, thank you very much for joining me today.
Thanks very much, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.